come on in.
Yeah, it's so nice. Have you been in this office for a long time, or?
A little over 2 years now.
Nice.
Yeah.
It's really kind of funny. Like I always discover new areas for Starbucks. I feel like Starbucks is expanding everywhere in the city. And I remember like I used to only come here for like cannolis or something like that. And now, I come here and it's gonna be like full of startup like Unity or AngelList or whoever is gonna be right there. We can just sit right here. I think actually, yeah.
Okay,
sorry. Let's do it right here.
That's perfect.
Yeah, this is so nice. And so, you've been doing this thing with Mattermark for a while of like looking at company and looking at kind of the data behind companies and really trying to understand all that. And I find it's an attitude that is actually very, very Silicon Valley-esque, right? Everybody wants the data, everybody wants to look at the data, or at least they say so. But I find like a lot of people don't necessarily understand that very, very well about Silicon Valley from the outside, and just the very basic precepts of like Silicon Valley not very understood. And so one thing that I really kind of wanted to dive into with you was this idea of growth. And growth is kind of central to a lot of things we do, whether we're a VC or we're a startup or you're looking at the data. But I think it's something a lot of people outside Silicon Valley, even if they do startups, don't really quite understand. And so why is growth so central, I guess, in a way, with everything like startups and companies now do in kind of the new economy?
Yeah, no, it's a great question. So, growth is really interesting because it didn't used to be so objectively measurable, right? Like we say data is important, but even when we started Mattermark in 2013, I think a lot of people really were like, no, you can't measure startups with data. It's an art. It's a gut feel. Right. And growth can feel like that too in the beginning, but the reason it's so important is people are buying the future. So you get a valuation from an investor, you raise a bunch of money, you're not just being valued on the business as it is today, you're making a promise about here's what we're going to do, here's what we're going to prove out. If you're getting a $100 million valuation, the idea is someday your company is going to generate $100 million of revenue.
Right.
And until then, you're going to be valued at some multiple of the future.
Right.
And so growth is about proving that you're going to get there.
Right. And it's been that kind of flight towards like that idea of like a future returns, right? And like in the early stage of investment, you were just happy to put money into a company that was selling like goods, and you were like going to get some returns on that margin of the good that were produced. And now I think so much of it has obviously turned into a little bit of forecasting, a little bit of trying to figure out where are going to be the big opportunities, where are you going to get bigger returns. And so essentially what people are doing, whether it's right here in Silicon Valley or in Wall Street, is kind of taking the risk of like maybe this company isn't going to grow that well, or maybe it's even going to go down completely, but if it does grow at the current rate or faster, then I'm going to get a really good share of returns, right? And I think that's kind of a big shift that's been happening. But so let's talk concretely about what that means, right? Would you say right now that like growth is like the top thing, or one of the top things a startup needs to worry about, or what does it rank in terms of the order of priorities for startups these days?
Wow, well, I think to grow, you have to have something to grow. So I think product generally ranks as the number one priority for most companies. And then some companies figure that out very quickly, and they're fortunate to find product market fit. And then from there, they can focus a lot more on scaling. But generally, product market fit is not a binary thing. It's more that you get it for some portion of the market, and then you get to a certain point, and then you need to get it again with some new set of customers. So it's kind of this iterative, product charges ahead into the future, builds things, then you grow. Then product has to then do its next, act, and then you grow again. And you don't just see this in startups; you see this in huge companies like Salesforce.
Right.
And so I think product and product market fit and growth, it's more like knowing where you are in that cycle.
Right.
And I think what happens is a lot of people get confused about where they are in the cycle, and that has a huge impact on things like when to fundraise, how much to fundraise, all these other questions. But primarily, it's about product. And when we say product market fit, that's almost become like this weird placeholder.
Right.
Like people aren't thinking, like link the two words in their product, the thing you're making, a market, people that you're talking to all the time, hopefully getting their money. So I think those two things are usually kind of like a yin-yang of what's the most important, and then everything else is orbiting around.
Right. No, it makes complete sense, like breaking this kind of so three things, right, of having a product, having that fit, and having the growth. And it's really, really interesting what you said about like maybe like realizing where you are. And I think there's a couple examples maybe we can go into about like what that means. So I've seen a lot of companies, for example, that arguably had a product and were pursuing growth, but didn't really have like product market fit in the sense that they weren't making money from it. And Facebook, or in the early days, kind of an example of that, right? Where you pursue growth maybe in the user acquisition sense and content audience sense, but you don't really have the product market fit in the traditional sense of like these people are paying you money directly. But in the end, it kind of works out, but that's maybe the edge case, right? That confirms the rule. And then conversely, I think there's also a lot of companies that have very strong product and very strong product market fit, but then the market is too small, and so their growth is capped. Even if they were to keep growing at the same rate, they would eventually own all the market and wouldn't be able to generate enough money.
Right.
So I think it's very kind of well put to kind of break that down as those three concepts. And so ideally, right, you find yourself in one of the phases of your company where you have a product market fit on a market that's big enough for you to actually grow and grow faster and faster. And that's kind of the typical, almost stereotypical struggle, right? That a startup has on an average day where the CEO is like, how can we grow faster?
Right, I mean, if it was easy, there probably wouldn't be an opportunity there. So that's part of it, is like most of the easy opportunities, easy is all relative, right? But whatever becomes easy gets picked over quickly. So like the bowling pin strategy of going into several different markets is generally difficult from an execution risk perspective,
right,
which means if you achieve it, it's valuable.
Right.
And so there's definitely that balance of some of the hardest things to execute are the most valuable if you get it right. Like in a way, what Facebook did was the hardest.
Right.
To execute on acquisition and then put off revenue long enough where you're taking a huge bet. You're taking a huge bet that you can aggregate enough interest, and then and not just that, but the execution risk of being able to deliver the ad business at the end of that. Twitter is a great example of maybe, they're still making billions of dollars, but maybe they haven't executed quite as well, yet they still have this huge audience, and you can see the difference in terms of how these two companies get valued.
Of course, yeah.
So I think in the consumer space, that's both the easiest and the hardest. It's easy in the sense of you get to put it off, but it's the hardest in terms of you've loaded all the risk on the back end.
Right, and I guess most startups kind of do a different version of that balance, right? Where maybe they don't trade off to the extreme that Facebook did of just saying like we're going to get users and money will come some way, but they're trading off profitability, right, for growth. And that's an example that we in Silicon Valley are like, yeah, of course you do that, and you never put a question, but that's not traditional economics, and a lot of people maybe wouldn't understand that you're saying it's better for me to grow my revenue even if I have zero profits. I'm not actually kind of turning a margin because that helps me kind of get more customers on board. That helps me kind of move the revenue curve higher. Yeah. And at least for a while, that was kind of the case, it seems, in some of the startups, but maybe you disagree.
I mean, first of all, I think I don't know enough about consumer businesses to say, to be super honest. I think in most businesses, margin does matter all the time. Like gross margin is one thing. Software businesses are wonderful in that sense. Operating margins being negative for a long time, I think all these startups do that. But I believe fundamentally your opportunity is a function of a combination of your market and the business model. So if the business model allows like a software margin, so we have 80% gross margins at Mattermark, and then your market is every business person in the world, you can do a lot of crazy things because you're like, well, long term there's enough out there. In the beginning, when we were just focused on VC, the market was really small, and the gross margin wasn't quite as good because the service level that was expected needed to be higher. Right. So then you make different choices. So I think it's a little harder in consumer because you basically don't know what your gross margin is. I mean, you can do a lot of things to try to figure that out, but ultimately you have an operating margin and you don't really know what your cost of sales is going to be. And so I think that's a very hard world to operate in. I honestly just don't feel like I know. Right,
but even in B2B, I feel like there's a similar kind of tension, right? I mean, I've worked in many enterprise software companies that that still don't have a profit, and I've become public now, and then just they're still kind of operating at a loss. And I think that's kind of a typical still kind of startup gambit of saying, no, we're going to recruit those customers, and eventually, we're going to lower our costs, we're going to increase our margin, we're going to get to profitability. But even that, it seems like the public markets still have more of an appetite for growth than they do for actual profit.
Well, they want return, right? So if they think that the management of the company believes it would be better to hold on to the money than to invest in the business, then why should they invest in the business, right? So there's a signaling issue there. People talk about signaling risk. That never goes away. That's existing in the public market too. So there's almost like this sweet spot of losing just enough money to show that you're continuing to invest in the business, but not losing so much that you've created some kind of existential threat. But yeah, I think that is the bet any technology company is making, is that it's going to become much more valuable in the future, and that we're at the beginning of a very long wave. And then of course, when other companies try to act like tech companies, public or private, generally they find that they don't get the same valuation or same kind of investor sentiment.
Right, and that can be really tricky, and it seems now that that reconciliation between like the private market and the public market is kind of interesting. And you have a series of blog posts that's really good about like ARR, for example, like annual recurring revenue, and kind of how that's changing between public and private market, and that keeps changing and remaking itself. But I think even the growth story has changed quite a bit, where I think in the olden days, at least the stereotype used to be like you were this kind of fast, kind of playing it loose company, and then you became public, and then it was about getting to profitability and doing all that. But now it seems like the story for you to IPO and to kind of be successful post-IPO is to still stay on that growth curve and still kind of go far beyond kind of the benchmark of Fortune 500, Global 2000, a stodgy old company. And so it seems like growth is kind of a central theme, even past your early Series A, Series B, Series C, and into private funding and public markets. So, what do you see as kind of a future trend? Do you think like we're going to stay indexed on that idea of growth? Do you think people are starting to look at other metrics as a key thing? What do you think is going to be the future, I guess, for that?
I mean, it depends on the time horizon. I don't think growth is actually a true imperative for companies. It's an imperative for investors. And so if you have investors, then that imperative exists. There's a couple of reasons. It's not just because investors want to return. It's also because investors have LPs who want to return. LPs have underlying constituents, and also we just have lifespans. Like, that's a huge problem, actually. So I think one thing you're going to see is you're going to see growth becoming less of an imperative for some companies and more of a choice. You're seeing a lot of companies like fashion brands trying to act like startups. I think, unfortunately, I don't expect that to play out very well. I don't think you get a 10x valuation multiple for making wool shoes. I think they're really cool, but that's just a difficult, racket. The margins on shoes are just the margins on shoes. They have been for a really long time. I think there's a growing degree of literacy, though, across just the entire ecosystem. I think investors for a long time held the asymmetry. They had like a lot more understanding of the market and than anybody else did. And I think founders and other participants in the ecosystem are getting smarter. So we're just going to see markets super long term, just be more rational and be more realistic, which will mean some people won't make as much money, but also means other people will make a lot more. So it continues to kind of all move towards the truth.
Right. And so maybe instead of being kind of that monoculture, that startup / VC high growth model is going to become one of the many models a startup can use to kind of build itself into growth. So,
absolutely. Yeah. And maybe there will be companies that we don't call startups that will go public, which actually would be a wonderful thing.
Yeah, that'd be nice. Thank you so much.
Yeah, absolutely. Thank you.